If everyone tried to withdraw their money today, most banks would run out of cash within hours, not days, hours. And the strange part? That's not a bug in the system. That's how the system was designed to work. So where exactly is your money right now? Because it's not sitting in a vault with your name on it. It's not in a digital safe somewhere waiting for you to come back. The moment you deposited it, it was already gone, put to work, lent out, circulating through the economy in ways most people never think about. And once you understand how this actually works, you'll never look at your bank account the same way again. Let's start with the thing almost everyone gets wrong. When you deposit money into a bank, most people imagine something like a storage unit. You put your stuff in, it stays there, you come back and get it later. The bank is just holding it for you, maybe charging a small fee, maybe paying you a little interest. Simple, safe, boring. That's not what happens. What actually happens is closer to this. You hand your money to the bank says thank you, and then it immediately lends most of that money to someone else. Not some of it, most of it. In the United States and most developed countries, banks are required to keep a small percentage of deposits on hand, historically around 10%, and lend out the rest. This is called fractional reserve banking, and it's the foundation of how the entire modern financial system operates. So you deposit $1,000. The bank keeps $100. The other $900? It's already on its way to becoming someone's mortgage, someone's car loan, someone's business line of credit. But here's where it gets genuinely strange. That $900 the bank just lent out doesn't disappear. The person who borrowed it spends it, and whoever receives that money deposits it into their own bank account. Now their bank keeps 10% of that, $90, and lends out the remaining $810. And it happens again, and again, and again. Your original $1,000 deposit, through this chain of lending and redepositing, can theoretically support somewhere between $5,000 and $10,000 in total loans circulating through the banking system at once. $1,000 in, up to $10,000 in economic activity out. This is the mechanism that economists call the money multiplier, and it sounds almost too strange to be real. But it's not magic. It's math, it's regulation, and it's the engine that makes modern economies function at the scale they do. Now let's talk about how banks actually make money. Because the interest on your savings account is almost certainly not paying for their skyscrapers. Banks make money through the spread, the difference between what they pay you to borrow your money and what they charge other people to borrow it. Right now, in most developed countries, a savings account pays somewhere between almost nothing and a few percent interest. Meanwhile, a mortgage might charge 4, 5, or 6%. A credit card might charge 15 to 25%. A personal loan falls somewhere in the middle. The bank borrows cheap from you, from other depositors, and lends expensive. The gap between those two numbers, multiplied across millions of accounts and billions of dollars in loans, is where the profit lives. You are, in a very real sense, a supplier of raw material to a lending business. Your deposit is inventory, and the bank's job is to deploy that inventory as efficiently as possible. But now here's the part that makes the whole thing feel slightly uncomfortable. When a bank lends money, something interesting happens to the money supply itself. Imagine you deposit $1,000. The bank lends $900 to someone buying a car. That borrower's account is credited with $900, money they can spend. But your account still shows $1,000. You haven't been debited. The $900 loan didn't come out of your balance. So now, between the two of you, there is effectively $1,900 in the banking system where there was originally $1,000. The loan created a new deposit. This is not a glitch. This is the mechanism. Every time a bank makes a loan, it creates a new deposit on the other side of that loan. The money supply expands through the act of lending. And this is why central banks, the Federal Reserve in the United States, the European Central Bank in Europe, have so much power over the economy. When they raise interest rates, borrowing becomes more expensive, fewer loans get made, fewer new deposits get created, and the money supply grows more slowly. When they cut rates, the opposite happens. They're not directly controlling your money, they're adjusting the conditions under which the entire lending machine operates. Now let's talk about what happens when the whole thing goes wrong, a bank run. It starts with fear. Maybe a rumor spreads that a bank is in trouble. Maybe there's a news story, a social media post, a whisper that the bank might not be able to pay people back. It doesn't even have to be true. People start showing up to withdraw their money. This is rational. If you think the bank might fail and you might lose your savings, getting your money out first makes complete sense. So more people show up, and the line gets longer, and the news covers the line, which makes more people scared, which makes the line longer still. Here's the problem. Remember that fractional reserve system? The bank only has a fraction of deposits on hand at any moment. If 10% of depositors show up tomorrow and want their cash, the bank can probably handle it. If 50% show up, it almost certainly cannot. There simply isn't enough physical cash in the building or accessible quickly enough to cover everyone. The bank isn't necessarily insolvent. It might have perfectly good loans on its books that will eventually be repaid. But good loans can't be converted into cash instantly. And if enough people demand their money at the same time, even a healthy bank can fail. This happened throughout history. During the Great Depression, bank runs wiped out thousands of American banks, and millions of ordinary people lost everything. The fear itself became the cause of the collapse, a self-fulfilling prophecy with devastating real-world consequences. So how does a system this fragile not collapse constantly? 3 things. First, deposit insurance. In the United States, the FDIC insures deposits up to $250,000 per account. If your bank fails, the government guarantees your money is safe up to that limit. This alone eliminates the main reason to panic. You don't need to rush to withdraw your money because even if the bank fails, you're covered. The insurance doesn't prevent bank failure, but it breaks the chain of fear that causes runs. Second, central bank backstops. The Federal Reserve can act as what economists call a lender of last resort. If a bank is fundamentally sound but temporarily short on cash, the central bank can lend it money, buying time for the bank to convert its assets without collapsing. This is an enormous safety valve. Third, regulation. Banks are required to hold capital buffers, their own money, not deposits, to absorb losses. They have to pass stress tests, proving they can survive serious economic downturns. They're monitored, audited, and constrained in ways that limit how aggressively they can lend. None of this makes the system fail-proof. 2008 proved that. But it makes catastrophic failure much rarer than the underlying mechanics would suggest. Which brings us to the part worth really sitting with. Your bank account is not a storage box. It never was. The number you see on your screen represents a claim, a promise from the bank that it will give you that amount of money on demand. But the money itself is out in the world. It's in someone's mortgage. It's funding a small business loan. It's part of a car payment. It has been lent and relent, deposited and redeposited, multiplied through the chain until it's become part of the circulatory system of the entire economy. You deposit money, it flows out. Someone borrows, spends. Someone else deposits. It flows out again. The same dollar cycling endlessly through businesses, households, banks, and back again. Each cycle creating a little more economic activity, a little more growth, a little more of what makes modern commerce function at the scale it does. The system works because most people don't try to withdraw everything at once. It's built on the statistical predictability of millions of people behaving normally, most of the time. And that's both the genius of it and the fragility of it. Your money isn't sitting still. It never was. From the moment it left your hands, it was already working. For the bank, for the borrower, for the economy. Your account balance is less a number and more a position in an enormous, interconnected, constantly moving financial machine. The vault exists, but it's not where your money is.